Welcome to this month's July OJM webinar, Do I Really Need an Investment Advisor? My name is Bob Peelman. I'm the Director of Investment Planning here at OJM. Often clients and investors alike ask themselves, do I need an investment advisor? I think it's a question that deserves some thought, and I think it's a question that we often get asked as advisors, what the value is being an advisor to a client, what we bring, and then also individual investors ask themselves, is it something that I need an advisor to pay for? So we're going to explore that today. We're going to look at some of the 9 common mistakes that investors make. And hopefully, as we go through this, you'll see some of the benefits that an investment advisor may bring outside of what we all think of with strictly investment returns or a hot stock idea, things of that nature. But some of the things that we might not think about with behavioral finance, behavioral investing, and as we go through that. So let's go ahead and get started. We'll get through a little bit of the disclaimers. All presentations have to have a couple disclaimers as we go through. Background on OJM, free to all attendees of this webinar. We have several materials available through our website, books, publications, newsletters that we have written. Please feel free to take advantage of some of our materials. Topics for today: who is OJM Group? We'll do a little bit more background. We'll again talk about the 9 common mistakes that individual investors face. And then we'll wrap up with how we manage money, what we do, how we think we distinguish ourselves, and how that will tie into some of the mistakes, again, that we see individual investors making. Our firm, we are a multi-specialty financial consulting firm. We have experts in the areas of insurance and benefit planning, tax, asset protection, corporate structure, retirement planning, and then our investment team, which I head up here at OJM. We handle everything from obviously building out asset allocations, dealing with individual equities, fixed income, exchange-traded funds, and on and on. So let's go ahead and get into the meat of the discussion. And this slide, I think, is a great slide to show, looking back historically, retail investors or individual investors, including physicians, including business owners. This is the full landscape of your quote-unquote average investor. Many investors all make the same mistakes, and those are greed and fear. Buying investments when prices are very high and selling them once they have fallen. According to the latest 2014 release of Dalbar's quantitative analysis of investment behavior, the average investor in a blend of equity, stock-like investments, fixed income mutual funds have garnered only a 2.5% net annualized rate of return. You can see that there at the bottom with the chart, the blue box, 2.5%. And this is the period ending up to December 31st of 2013. During that same period, the S&P 500 returned 9.2%. So we see a clear underperformance by a very large magnitude. And again, you can see some of these other asset classes. So, so why is that? Why are average investors lacking the types of returns that we see in the market? And so that's what we're going to explore today and look at what these common mistakes are, what we see. In 2010, the Securities and Exchange Commission put together a publication. They prepared a white paper report on U.S. individual investors, and they identified 9 common investing mistakes that affect investment performance. And these traits are common behavioral characteristics that work against your investment returns, usually because investors become too emotionally involved in the decision-making process. So you can see here the 9 mistakes laid out. What I'd like to do today is kind of walk through some of these mistakes, provide a little context where I've seen these mistakes pop up, and then, as I said, we'll wrap up with the contrast between how we manage money here at OJM. So the first mistake that we see very commonly is active trading, which is, very simply, an investor will begin to engage in regular buying and selling of investments. They'll begin monitoring the prices and timing activity, trying to look at certain market conditions. But in reality, that constant activity and speculative behavior is very detrimental to long-term performance. It's very difficult to time the market. I heard a good piece of advice. It's a little bit of a cheesy line, but when I first entered the business some 10+ years ago, an advisor once told me, a client's portfolio is almost like a bar of soap. The more you do to it, the more you manipulate it, the less you have. And I think that holds true. I think trying to make multiple trades and get cute with a portfolio is very detrimental to the long-term hopes of the portfolio. So what a good advisor should be doing is laying out a strategic plan, and there's not a lot of activity for the sake of activity. So I think this is an obvious one, but I think it's one that investors sometimes fall prey to. The next one we'll look at is disposition effect, and again, this is one where retail or quote-unquote individual investors become very emotional with their money and begin to hold on to a losing investment too long, and may sell the winning ones too soon. By nature, most investors are risk averse, but even more so when they're handling their own money. So a lot of questionnaires. We try to profile our clients, but the one thing you'll find is some of the answers that you may see on a questionnaire in reality is what an investor wishes or hopes their risk tolerance were, but not necessarily what it is. And so a true measure of risk is sometimes difficult for advisors to ascertain, but as we go through, one thing that is very clear is you will find individual investors really becoming very emotionally involved with investments and holding on to them maybe too long. So one of the ways we try to counteract that is by creating a systematic rebalancing system for our clients. So we'll go through and make sure, as you can see on here, the name of the game in investing is buying low and selling high. We'll make sure that if assets in your portfolio begin to grow outside of what our target is, we will rebalance them and trim them and put those dollars into some of your underperforming asset classes. So again, these are the types of things advisors can do for investors that I think are very important, which is creating that systematic rebalancing of a portfolio, and it will help alleviate some of that disposition effect. Another big one is familiarity bias, which is the tendency for investors to look for investment opportunities that are familiar to them. It's very common for many of our physician clients to want to look at biotech companies or things in the healthcare field, or local executives that we deal with looking at something that's strictly in their sector, or again looking at things that where I shop, the things that I purchase. That can be a fun strategy to want to own a certain stock because you happen to frequent it, or you happen to like Apple products, you want to buy Apple. The problem is you can become too heavily involved in a local stock and have a little bit of blinders. And so when you see employees investing too heavily in their company stock, that's a red flag for an advisor, and you want to make sure that you've got an advisor looking at concentrated positions, understanding why you may have them, and making sure that you're properly diversified. I think limiting some of that exposure isn't going to remove all risk from your portfolio, but it's going to be a very big help to ensuring that your portfolio consistently matches what your level of risk is. Another one we see quite a bit is returns over fees. At OJM, we've got several principles when we manage our portfolios, such as transparency. But one of the biggest ones is trying to keep fees as low as possible. I think all clients understand that a professional needs to be paid. So obviously we need to be paid at OJM for the work that we do, but it has to be reasonable. And the advisor needs to do a very good job of making sure that the investments that are selected also have a fee structure that is very advantageous for the client. And so a lot of times what we'll see is investors will bring to us a mutual fund that may have a great 1-year, 2-year track record, and they're ignoring such things as expense ratios, 12b1 fees, transaction costs, and all of these things can be a significant drag on performance of the portfolio. So, I ran an analysis not too long ago for a client who had was paying their advisor 1.5%, but the total fee structure of all the mutual funds that they had purchased was another 2.75%, extremely high. And so very difficult to grow a portfolio with that types of fee structure. So while exceptional performance is very important, we also want to look at how and why that mutual fund manager may be getting that performance and what type of fee are they taking from the fund annually and reducing your overall return. So extremely important there. Today's 24-hour news cycle, this mania and panic is very something that we fight against in the industry. Everyone has CNBC turned on, and in today's news, we don't really know what is a breaking news story anymore. Almost everything is breaking news. And so it begins to create this type of panic for investors where everyone kind of gravitates back to the fall of 2008 and 2009, thinking about when is the next crash coming? When is the next bubble coming? What is all of the shows on TV are about individual stock picking, which again is not how high net worth clients build portfolios. That's just not how you build true wealth, by looking for the next great stock. And so a lot of what is seen on TV in this 24-hour news cycle fights against the individual retail investor, because a lot of this noise is difficult to filter through and stay focused on your portfolio. For the last 4 to 5 years, everyone has been waiting for the next crash, the next panic, and a lot of investors may have missed 150, 175% rise in a portfolio cumulatively while still waiting for that shoe to drop. And kind of dovetailing right off of that, we have noise trading, which takes place when investors decide to take action with actually doing some analysis. When we're looking strictly at daily headlines, short-term volatility, and so these types of things, these false signals to your portfolio, can be very detrimental. It's very important that the advisor takes the emotion out of the portfolio. I often tell clients that, and it's the same for me personally, your money is emotional to you. For your advisor, it's a business. And it's very important to separate those two, because when you're managing your own portfolio, the highs are very high and the lows are very low. And it's very difficult to maintain a level head throughout crisis. And so it's the professional's job to walk you through those times and make sure that what you're doing still makes sense and that you're still on track. So I think some of that noise trading, again, is a big issue for individual investors. This chart I like quite a bit because it shows you since 1980 the growth of being an investor in stocks and treasury bills. You can see here that this chart here, starting back in 1980, you would have a portfolio that, through many ups and downs, which would have grown to $330,000. A $10,000 investment in 1980, not adding to it at all, leaving it alone, would be $330,000 in 2012, at the end of 2012. Now, you can see we've had many wars, many crises. savings and loan bailout, war in Iraq, dot-com bubble, the 2001 Trade Center and Pentagon attacks. And the one thing you can always see is what you never want to do is get wrapped up in those highs and lows. Because if you stay the course and you understand the strategy that your advisor has laid out for you is a sound one, you'll be able to ride through these issues and make sure you have a portfolio that when you're ready to begin having your portfolio begin to generate income for you, that it's there. It's the size that you set the goal for and you're prepared for retirement. And so I think that's an important thing as we look at this chart to see that there are many things out there since 1980, and this goes well beyond that, that will fight against you, and this is a nice chart to illustrate that. Okay, let's go through here. Momentum investing. Again, this is an area where buying individual securities with recent high returns and then selling the securities with low recent returns, assuming that the past trends and performance will continue. Chasing this momentum leads to a lot of bubbles, inflating of prices when the fundamentals may not necessarily hold true. And so this type of momentum investing is very, very common. I often tell prospects or clients, if I'm happen to be on a flight, you'll see a lot of investor magazines, and I say by the time an investment gets into that magazine as the next great investment, all the money has already been made. So by the time an individual investor is reading about an individual stock, the next great mutual fund, 9 times out of 10, the money in that investment has already been baked in. And so investors will get in late, they'll look at the past momentum, and then conversely try to time that on the downside again. So, this slide here illustrates, market and sector forces together combine about 80% of the price movement in a stock. I often get asked on Monday morning before the market opens, a company will come out with tremendous earnings, beat all expectations, market opens and the stock is down 2%. And for no rhyme or reason, it doesn't make any sense that the company had phenomenal earnings, their sales were through the roof, but at the same time they end up having a pretty negative day in the market. A lot of that is because only about 20% of a stock's price movement has to do with the individual balance sheet fundamentals of a company. You'll see a lot of these sector forces beginning to move a stock independently of that. And so we saw this a lot in 2008 with the banking and brokerage sector. So it's very difficult to try to be a momentum investor and ride the wave of what's doing well, because it's very difficult to figure out what individual investment you want to select within inside of that sector. So I think, again, this is an area, one of the things that we do at OJM is sector rotation, where we own the top 5 sectors for our clients, and so it keeps us on a very disciplined strategy and not getting too wrapped up or involved with the daily fluctuations. Under diversification, again, this happens when investors become too heavily concentrated in a specific investment. They increase their exposure by having too many eggs in one basket. This is an obvious area where it's very important for investors to look for advice on this. One thing that can happen is you have one investment that you purchase, it starts doing well, you buy more, and then as that investment's doing well, it begins to grow and become a larger percentage of your portfolio, and before you know it, when there is a market correction or a downside, you begin to be exposed much more to a higher risk level than you may have been comfortable with, and so under diversification can happen, where portfolio we look at it and it's not the way that you think it is because of not having the rebalancing and dollar cost averaging into maybe one investment over another. Naive diversification is simply when investors begin to diversify between a number of investments in equal proportions rather than strategic proportions. Remember, proper diversification with an investment is not simply putting X asset in X equal percentages, rather a proper allocation strategy. I often tell our clients it's far more important to have the correct asset allocation than it is to have the correct investment. You can make mistakes with having the wrong, owning ConocoPhillips and not owning Exxon. You can make that mistake. Where you run into trouble is having 30% of your money allocated to emerging markets and maybe only 10% to fixed income. Having the incorrect allocation and not having the proper diversification will certainly hurt you far more than almost anything in your portfolio. And you can see here on the Quilt Chart here, we've all seen these back when we were in grade school, and it looks like in your chemistry class, all the different elements. But as we look at this, each color represents a separate asset class. And so sometimes investors want to look at what has been performing very well, what was the top performer, and look at maybe what will do well the following year, when in reality it's very difficult to try to put your eggs in one basket. And one thing you'll notice is in the middle there, a very well-diversified portfolio. The highs are not going to be too high, and the lows certainly will not be too low, and you'll have a very, very comfortable return. This particular time period, a diversified portfolio with a blend of all of these investments returned a net of 7.2%. You can see that taking the risk of owning, let's say, all emerging markets at the top there would have returned you a few more percentage points at 11%, but you would have been riding a wave. Just for example, looking back to 2007, you would have been up 39% one year. The next year you would have been down 53%. The next year you're up 79%. Then 19, and then down 18. It's a very difficult wave to ride for investors to see $1 million portfolio turn into 500,000 and then go up to 1.5 million and back down to receive a few percentage points higher of return. And this is only for a time period going back to 2004. So, we really try to build a portfolio that has a very institutional style of investing and discipline, and I think that's very important for investors. Client-driven portfolios. We look at creating a strategy for our clients, and when we do that, we want to look at things like assessing your risk, understanding what your one-year loss threshold is, and then very importantly, putting together an investment policy statement. This is a very important document between an advisor and an individual investor. I often ask my clients about their investment policy statement. Many times they don't have them, but it's very important to set the objectives with your advisor. What type of return you expect, what given level of risk you're willing to take. And talk that through with your advisor, because it'll set the expectations for your annual reviews, and you'll have a clear understanding of, am I getting the type of return that I should be getting for the given level of risk? If not, why? And if so, can we continue to maintain that through different market conditions? So it's a very important thing to lay out, and it'll help keep you on track as well. It'll also help hold your advisor accountable and you accountable. So I think it's a very important document when we look at creating portfolios for our clients. So a portfolio managed by OJM. Again, we take a very institutional investment approach when we're managing assets. What that means is, instead of the retail investment style of selecting individual mutual funds, we look at building a portfolio with alternative investments, very long-term approach, thinking a lot about how endowments manage assets, large foundations. That the thinking is we can get you the types of returns that you want with taking a far lower level of risk. And so I think that's a very important thing. We've got a dedicated team of investment experts who focus solely on investment management at OJM, which is a very important part of how we structure our portfolios. We have several professionals outside of the investment team that we lean on for areas of tax and asset protection, and the thread runs between each department at OJM, which is very important when we coordinate plans for our clients. We use strategic asset allocation, but also are looking for some tactical opportunities. So that's a very important piece of what we do. We look at things such as the next 5 years for our clients and opportunities that we may see during that 5-year period of time. So non-correlated investments are very important with what we do. I mentioned that institutional style of approach. Alternative investments are a very key component to that, and that allows to have some lower correlated investments to the stock market that will help smooth out some of those returns. So next steps, get a free copy of For Doctors Only, Wealth Secrets of the Affluent, or one of the other books that we referenced earlier in this presentation. We'd love for you to sign up for our e-newsletter, clicking the link below in this window. And, we are happy to give you a free consultation or answer any questions that you may have. My contact information is here. Again, I'm the Director of Investment Planning. We have a wonderful team here on the wealth management side and OJM as a whole. So we're happy to sit down with you, answer any of the questions, talk about this presentation, and certainly dive into your individual situation as needed. Thank you for your time today. We appreciate it, and we look forward to hearing from you.